This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Hello, everyone. This is AJ Monty joining in live right now at the top of the hour. It's 8 p.m. Eastern Time, and we are going to get right into the open house Q&A. As I mentioned in the warm-up to this call, I wanted to show you here. There's a news flash that just came out. Very unfortunate. In Manchester Arena, there was a concert there, and there was an explosion. Now, I don't. This is the first news that I'm getting from NBC, and I'm trying to find out if Bloomberg or even CNBC is reporting anything, because when you have an American president traveling abroad, and actually he's in Saudi Arabia and in Israel, and then you have an event that could very well be linked to some terrorist organization. This is, again, very unfortunate news that usually impacts the markets the following day. And this is really what causes extreme volatility. And again, I'm not going to speculate at this point. I'm just getting the news like you are. And as we look at this and the markets, I want to factor this in for the opening tomorrow, so that all of you investors and traders alike can protect yourselves in at least a financial sense of the word. So I'll put that on the back burner right now as we go into the markets. Now, I was spending most of my day today looking for our next trade candidate. And for those of you that would like to know how my process works, is I usually spend the first part of every new week looking at the news, looking at the markets, analyzing the charts. And my trade candidates for both the option traders and the equity traders usually come out towards midweek, or in most cases towards the end of each week. And that's by design. The whole idea is to allow the market to trade, and then when you start to position yourself towards the end of each week, that gives you a better edge with regard to increasing the probability of your trade based on what the weekly chart looks like. Now, I'm using potash as an example because this is one of the positions that we hold. And potash opened up higher. It actually gapped up. Let me zoom in here for you. The stock gapped up on the opening right here. You see, on Friday, we had a big gap up with a big green candle on high green volume. The stock today opened up at this resistance point right here. You see that arrow right there. And today's high matches up against that previous high. Now, when you're looking at a stock that does this, and it's the beginning of the week, even though it closed slightly over the 20-period moving average, this is a candidate that if you're thinking about getting into, it's best to wait towards the end of the week to see how this stock plays out. So if I'm looking at this with fresh eyes as a new position and I didn't have an existing position, I would most likely wait for the stock to come back to fill the gap down here, wait for a bounce, and then get back into it. And then chances are this bounce and pivot point off of that gap fill support, again, increases the probability of making money. Now, this stock has not broken down below key support levels, so even though we're in this, we're still in it. But if you're looking to take a new position, you would most likely wait for a pullback. So that's how we look at a market like this. And then if you take the same stock and you look at a weekly chart, you see a slightly different picture. You see this arrow, again, represents what I just pulled off of the daily chart as resistance. But last week's candle shows an extreme hammer pattern. You see that? So if you have a bullish sign here, but you're waiting towards the end of the week and the stock pulls back, you might very well wind up with a bearish engulfing pattern here after the hammer pattern. You see, so again, many times it's best to wait towards the end of the week than trying to speculate at the beginning of the week. So again, I'm using that as an example here to show you how to progress through the trading week if you're a swing trader. Now, I do not promote day trading at all, but for those who are day traders, it is always best to wait towards the end of a day to get your trade set up for the following day, like we would wait towards the end of a week as a swing trading strategy. Okay, now as I look at the attendees, we have a good group of folks. How many of you, if you could, after I ask the question, of course, by show of hands, there's a little hand icon up there. By show of hands, how many of you are non-members, not a member of either one of our subscription services? How many of you are not a member of the Option Oracle or the Equity Oracle? Not. Okay, and just by show of hands. Okay. All right. Thank you. Thank you. I see a bunch of hands. Okay. Now, the reason I asked that is because this open house is normally open for members only. And I opened it up this one time for non-members so that they can get a feel for what the market guys do with regard to education. So now that I know that there's a lot of folks that are non-members, I'm going to put out some information towards the end of this presentation that'll be very helpful for you. Okay, we're doing a special promotion for the non-members. And so stay tuned for that. Now, as I always do, now, if you can answer questions. You can answer questions anytime at all. Let me just see. I got to take care of a little housekeeping here. Hold on. Where is that? All right. I'm going to take care. There we go. All right. Now, we are going to go over the markets as I do each and every week. Now, this is a chart of the diamonds, and the lines that you see on the chart are actually from last Friday's weekly market report. So this diagonal line is what I drew last Friday after the close as a forecast for what I believe was going to happen this week. And you can see that here we are Monday, already on track for keeping this upward trend going, because my forecast was that we would most likely continue a little bit higher in an attempt to fill the gap up here. Now, for those who are non-members, understand that gap trading is extremely important for you to learn. Whether you plan on investing or trading, it doesn't matter. Gaps are a very significant part of today's markets, because gaps are generally formed by a shocking news event, an earnings surprise, something of that nature, where it kind of jolts the market. Now, back here, you can see that the market gapped up right there on April 24th, and then on April 25th, it gapped up again. Now, remember, this is the Dow Jones Industrial Average through the diamonds that gapped up. Now, when the market gaps or any stock gaps, there is an 80% chance that the gap will fill. And I know this is repetition for a lot of you, but hey, repetition's the best teacher. There's an 80% chance that the gap will fill. And then once it fills, there's an 80% chance that the market will reverse. Again, using this as an example, you can see the market gapped up here, gapped up again. On this day, the gap filled here. On this day, the second gap filled. And then what happened? Again, to the penny, when that gap filled on Thursday, the market reversed and started going up. You see how important that is? Here again, here's a gap back here. The gap occurred on market news that came out prior to the opening on March 1st, gapped up, and then what happened? The gap filled on this day. See this line right here. Now, I'm not going to draw too many more lines because I keep these lines on each and every week so we could reference them at the end of each week. So here we go. The gap filled, and then it reversed. Now, if you look more closely, you'll see there's a small gap below the market down here, right around 199 for the diamonds. Now, if the gap rule states that 80% of the time the gap is formed, 80% of the time it fills, then that also means 20% of the gaps do not fill. That's also a very important part of this rule. So although we are going to keep our eyes on that gap and this very, very small gap right here, we have to keep that 80-20 rule in mind. Now, there is one exception to the rule, and I'm going to get to that in more detail when we talk about the VIX. The VIX, which is the volatility index for the S&P, and the Russell 2000 volatility index, those indices are the only ones that have 100% gap fill rate. 100% of the gaps have filled over time because those are oscillating indicators. They're not stocks. So the VIX, 100% of the time, will fill eventually all gaps. Again, keep that in mind. That rule, by the way, comes from my research and no one else's. That's 35 years of research and tracking gaps, both on the volatility index and other stocks. I keep very stringent records on whatever I do. I record everything, just like these weekly market reports that I do in each and every week. I have a record that I can go back to and prove this to people. And I also encourage each and every one of you to do your own gap research. Go back randomly, pick any 10 stocks, 20 stocks, whatever, how much time you want to put on into that research is up to you. But pick any stocks, any group of stocks randomly, look at the number of gaps that are formed, and then after the gap is formed, look at the number of times the gaps have filled, and then take one more step and look at how many times the stock price has reversed after the gap has filled. Just do a simple spreadsheet, and you'll see the 80-20 rule all over the place. It's just very, very consistent that way. Okay, so again, looking at this angle of the forecast, my comments were that there's a good chance that this gap will fill. And then I said last Friday that once the gap fills, there's a good chance the market will reverse from that point and start to go back down because we are in a trading channel. Now, again, this is the Dow Jones Industrial Average. If you look at the S&P, which is the spiders, this is 500 stocks that are tracked on an index like this. I said, again, I'll zoom in here. I said that there was a good chance, again, my forecast was that the gap here was going to fill. Today, it filled. Isn't that interesting? So the S&P has already filled. The Dow has not filled yet. And I said, once the gap fills, there's an 80% chance of a reversal. We'll have to see what happens. Looking at the Russell 2000, and I'm not going to spend a whole lot of time analyzing here, but the Russell 2000, again, on track to stick with my forecast line with the gap fill point for the Russell 2000 right there around 1393. Okay, so keep that target in mind. Finally, if we look at the Qs, that's the QQQ NASDAQ Power Shares. Again, remember, this line was what I drew last Friday. This price had not happened yet. I said there is a very high probability that the gap on the Qs would fill. Today, the gap has filled. And finally, look at the VIX. And I continue, because I know how certain I am of this, I continue to stake my reputation on gaps filling for the VIX. And I said last Friday that there was a very high probability, and I said I would stake my reputation on that this gap down here would fill. See, from this low to this high, or from this high to that low, is a gap. Today, it almost filled perfectly tomorrow, I think the price range for the VIX, I think tomorrow that gap will fill completely. Now, again, this is all speculation, and you're hearing it the day before, of course, the market opens. But once this gap fills, now I'm giving you a test question here, see who's been paying attention. Once this VIX gap price fills, what's going to happen? Most likely 80% of the time, what's going to happen? What do we expect the price to do after that gap fills? Gil was first to answer. Actually, David was. And you're both right. The VIX, once the gap is filled, is now expected to reverse, again, just like my forecast line suggests. Now, the most important thing you have to know about the VIX is that it's contrarian indicator to the S&P. So if the VIX is got a high probability of going up, that means the S&P has a very great chance of dropping, because remember, they're inversely related. Okay. Now, Rick has a question. He says, I took a long position in EGRX last week. It is reversing. Is that after a gap, Rick? Let's see. I'm just looking at this. I'm not going to take stock symbols right now, but I want to look at EGRX. Is it EG? Let's see. Hold on. EGRX. Let's see. Is that a Canadian stock? No. Okay. All right. So, all right. Now, if you're taking a long position, if you took a long position last week, now I'll have to analyze this later, because this is a questionable one. If the stock is closing down below the 20-period moving average, you got to watch that one. But the good news for you, Rick, is that there's a gap above the market that we'll have to see whether or not that gap fills. But if you're long this stock and it fills that gap, you could very well see the stock, once the gap fills, you could see the stock reverse. High probability that that will happen. So I would be very, very much on guard if you own the stock after the gap fills, because now there's an 80% chance the stock is going to drop. So I would say on the most optimistic short-term picture, 94, 95 is going to be your price target. Then you got to watch that. Then you got to get out. Now, I want to tell you something, folks, because something happened to me today that was very relevant for trading and risk management. And for the longest time, especially in my book, the 5 Points for Trading Success, for those of you who have read it, I talk about having a plan, a trading strategy that includes a plan. The plan should have within it some sort of a checklist that you need to follow before you get into any stock, while you're in a particular stock, and while you're exiting that position, whether it be for profit or loss. You should have a checklist. You should be analyzing price and the direction of that price. You should be analyzing the volume. You should be looking for gaps, price patterns, candle patterns, like bullish engulfing patterns, hammer patterns, things of that nature. You should be on guard every single day when you have your money at risk. All right. Now, today, true story, I had one of my airplanes was being worked on. I needed to put in a new fuel tank. There was a fuel leak, blah, blah, blah. The mechanic replaced the tank, got it going. I drove over to the airport. Actually, my wife drove me over to the airport to pick the plane up. I get in the cockpit. I go through my checklists. Now, do we have any pilots online, by the way? Just raise your hand if you're a private pilot, commercial pilot. Dennis, you're a pilot. Okay. Dylan, you're a pilot. Either that or you just left your hand up. Joseph, okay. Wow, a lot of pilots. If you're not a pilot, you just left your hand up. Put your hand back down, because that's unusual high number of pilots on the call. I never get that many pilots. Okay. All right. There we go. Hands dropped. Some at least. All right. Now listen. If you are in the cockpit of an airplane, I don't care how good your memory is. You need to go through checklists. You have to make sure that the fuel is on. You have to make sure that the controls are working. You have to make sure your seatbelt's on. You have to make sure the doors are locked. You have to make sure that your instrument panel is in check. You got the right vacuum, oil pressure. You got fuel flowing to the cylinders. You have to make sure all of that is in check. Well, let me tell you something, folks. If I did not use my checklist today, I would not be speaking with you right now because I would have crashed my plane. This is exactly what happened. I get in the cockpit, I do my pre-flight checklist, checking to make sure my fuel is in order. Both tanks are on, going good. Now remember, my mechanic just got finished replacing a fuel tank. I think some of you already know where I'm going with this. But the mechanic did not finish his checklist. See, before a mechanic hands a plane over to you after they've worked on, especially if it's on a fuel line, fuel tanks, anything that has to do with fuel or the engine, they have to make sure that engine is up and running and ready to go. So they can sign off on the plane, you get in, and you can go. Well, guess what? The fuel line hadn't been totally bled of any air that was in the fuel line. So I'm doing my run up, I'm running the engines up, and boom, all of a sudden, engine comes to a complete stop, runs out of fuel because there was air in the fuel line. So I go to my checklist again, prime the engine, pump it through, run it, do my run up, ready to go. I even had the mechanic come back out to check the engine to make sure everything was all good before I decided I was going to take off. Folks, if I didn't have my checklist in place, if I didn't get through, I would have been on the runway, I would have hit full throttle, and I might have even been up in the air taking off, and my engine would have died, and I would have crashed. Absolutely would have crashed. Now, what's my point? My point is, we're not obviously in an airplane right now as we're looking at the markets, but you are taking a certain level of risk that does include your financial affairs. You are putting hard-earned money into the market. And if you're just free-forming your strategy as we go based on what you're seeing on CNBC or BNN if you're up there in Canada, if you're going that way, that's the equivalent of you getting in the cockpit of an airplane and not using a checklist. And eventually, you're going to have an accident, or the market's going to take money and you're going to crash. See, I take this very seriously. I take this extremely seriously. And I have a mission to help you make money. Now, I know not every single person on this call is going to make money because not everyone has the same level of discipline. I could only encourage you to take those steps towards managing risk, but ultimately, you are the pilot of your own account. You're the one pushing the buttons. You're the one getting into a stock, and you're the one taking risk. The only thing I have to do is encourage you to follow the steps and go over your checklist. So tonight, what I thought I'd do is, as I'm analyzing your stocks, I will then go through the checklist that I use while analyzing the stock. And I'm going to keep this according to the 5 points for trading success that I've written about and have a best-selling book about. Okay, so I'm going to follow those steps as we look at your stocks. So with that, who would like to submit the first stock symbol? And if you could, put in a stock symbol and let me know what your position is, or let me know what you're thinking about with regard to getting into the stock. Okay, so Ron, first one up, and I'm going to take these in order, okay? Actually, Sean, I think you got in there before, so I'll get to you next. But Ron is looking at TNK, and the question or statement is this a good entry point? Okay, now, TNK, this is TK Tankers Limited. Let's look at this. First of all, I'm noticing a very low price, which I'm always on guard about, because when a stock drops below $4.50, it generally goes into free fall because the margin requirements change. That's number one. Number two, we have a stock, a cheap stock. It's trading only a little bit over $2. Keep that in mind, Ron. Cheap is not always best, but that's the one you brought up. You see that when you have cheap stocks like this, the institutions, the banks, the money managers, and the institutional traders generally shy away from stocks like this, okay, because they have to put in a lot of money on a cheap stock will actually move the stock against them when they're getting in and out. So they tend to go for the higher price stocks. So here's the checklist. I first want to check the trend. What's the trend doing? The trend is in a downward trend. There's no question the stock's in a downward trend. The 20-period moving average is confirming that downward trend. The only good thing that I see is that we have a close over the 20-period moving average. Now, what does that mean? Well, when a stock closes over the 20-period moving average, that's usually a good sign that the stock is making an attempt to break its trend and start to go up. Okay, now that might sound like good news, but my next question is, once I understand where the trend is, I now have to identify where resistance is. If I'm a buyer, I want to know where resistance and support is. Now, my eye is gravitating to these lows. See, this is an area where buyers came in and pushed the stock up. So this low, and even this low and these lows are general areas of resistance. Now, if I draw a horizontal line from that point, see, support, 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 support. Once support is now broken, who could tell me what happens to that support line when it's broken? Who wants to give me the answer to that? It's called role reversal. What does that mean? Anybody? I know there's a little bit of a delay. Okay, Stuart is correct. First to answer, when support is broken, that line then turns to resistance. So today's high actually was a point of resistance. You could see how once the stock got to that point, sellers came in with dramatic selling pressure, pushed the stock down from the highs. So all of those things tell me that the sellers are still fighting back. You see, so I'm going to tell you, Ron, although this is a cheap stock, I would wait for this stock to bounce off of a key support level, which could be the 20-period moving average now. You see, because once a stock closes over the 20-period moving average, that moving average becomes support. So if the stock comes down to the $2 level and then starts to bounce and go up, I would actually wait for that stock to do that first before I get into the cockpit, more or less, and take a position in that stock. Now, if the stock bounces tomorrow off of that 20-period moving average and I decide to get in, because it's a green candle, let's say, then my new support level is going to be down here. So if I buy it at around $2, I'm going to put my stop somewhere below 190. So that's my escape hatch. See, so that's the checklist. Identify the trend, identify support, resistance and such, look for the pivot point, and then establish my exit strategy, which would be the stop below support. So if all those things look good tomorrow, I see a green candle, I see the price going up and staying over that support, that would be an entry point for me. But because of the cheapness of the stock per share, I would be very, very quick to get out if it breaks down below support. Personally, I wouldn't touch this one only because it's so cheap. If I had a stock that had extremely high institutional ownership, that might be a different story, but you have to really sell me hard on that one. Okay, now I promised Sean that I would look at MGM, and Sean says he's short at 31.57. So MGM, there we go. Short it at 31.57, which is pretty much on the close today. And let's look at this now. We have a stock that has been going up. So the trend is up. And that trend, the short-term trend, also known as a trading leg, is following almost exactly on top of that 20-period moving average. Keep that in mind because that's the line I would use for support. Now, if I drew a line parallel to that trend line, it's obvious to see that by connecting these highs, I'm in an upward trading channel. So I can obviously see the stock is in an upward channel. Now, I have to identify, because I already know where support and resistance is. Support is the trend line, resistance is the channel line. Now I have to see if the stock is pivoting. I'm looking at telltale signs of bullish candles. And from what I can see, I do not see any bullish signs here. I see green candles, but what are these vertical lines that we're seeing above the candle? Who wants to tell me that? Those long vertical lines above the candle, tell me what? Who? Now I know there's a lot. Okay, those could be known as wicks. They're also known as shadows. But what does it mean when there's long shadows above the candle? Okay, I know there's that lag time. We're going to wait for a couple of answers to pop in there. I know we have an active audience today, so I know we're going to get some answers. Okay, Stuart says, let's see, Stuart says, try to push the price higher. That means the long shadows above the candle mean that on these 3 days, Thursday, Friday, and Saturday, the buyers tried to push it up, which they did, but the long shadows mean the sellers came in and pushed it down from the highs. So what that tells us is that the sellers are very present. And so when I see that, it tells me that the sellers are trying really hard to push it down. So if you're short the stock, that would be a good thing. If you have a stop at 32.17, I would say that's a little bit too low. And here's why. Because if you're short the stock, you want to put your stop above a key resistance point, which would be this high is 32.28. So actually, I would raise my stop to maybe 32.25 or something like that. Actually, 32.35. I would put a stop a little bit higher than what you have right there, because this stock could actually touch that high tomorrow and then start to pivot lower. So what you want to see over the next couple of days, or maybe some red candles, you definitely want to see the stock trading down below the 20-period moving average. Here's your checklist now. And you definitely want to see the volume start to drop. The drop in volume tells us that the buyers will start to run out of buying power. They're going to start to give up on the price if they can't maintain the higher levels. So a drop in volume will be a sign of weakness in that upward trend. Now, I know I took a little bit more time than usual on Sean's stock, but I'm telling you, folks, this is going to help each and every one of you if you could see my checklist, okay? Because the percentage of accuracy here using candle charts, when done correctly, is extremely high. And I prove this each and every week by the market reports I put out. I also prove it each and every month, because if you go back and listen to the recording that's available to all the subscribers, you'll know and see with your own eyes the evidence in the forecast that I put out on each one of these stocks. Okay, now Leslie says, CXW, thinking of shorting. Now this is interesting because I normally don't get this much short interest, and I like it because the market, with the VIX being so low, the market is forming a top. So if you're thinking about ways to make money on the way down, I'm loving that. Now, if Leslie is looking at CXW here, and I'm looking at this chart, who could tell me what this 2-day price pattern is telling us? What is the name of this 2-candle pattern right there? Can anyone tell me? I know, 1, 2, 3. Answer should be popping up right about now due to the lag. And there we go. Lloyd, first to answer, bearish engulfing pattern. Bearish engulfing patterns when you have a large bodied red candle overlapping, eclipsing, or engulfing the previous green body. That is bearish. The other thing that I see is from Friday, we have a long shadow above the candle, which is also bearish. So the forecast for this one would be what? Bearish. Now, the good thing is the volume is dropping as the stock has gone up here. You see, on Thursday, Friday, stock went up, but the volume is dropping. That tells us that the buyers are losing momentum. Sellers come in here with a convincing bearish engulfing pattern. We see that there's a very strong pattern of downward action after bearish engulfing patterns form. See that over and over again. Look at this one up here. Bearish engulfing pattern, big red candle after a smaller green candle. What happened? Stock went down. Here's a bearish engulfing pattern, big red candle again, prior smaller green candle right there. Stock went down again. We see any more? I don't see too many other bearish engulfing patterns, so you have to. Well, here's one, very small, and the stock dropped a little bit, didn't collapse, but it definitely went lower. And do we see any other bearish engulfing patterns? No, not that I could see. Okay, so Leslie, that would be something that you want to very much pay attention to. And if you are short the stock or thinking about shorting the stock, who would like to suggest an area of stop? Now, if you're shorting the stock, you have to put a buy stop to protect yourself. Who wants to put a price level out there suggesting a good buy stop area? Let's see. Anybody? No, you have, Leslie, you see you have a target gap at 18.5. I personally would not ride a short position that far. If it's trading 30.41, I think shorting it all the way down to 18 would be a long shot. I really do. I think that your next short level would be maybe this support level back here. That would be my target, maybe around 28.75, something like that. Because if it gets down here, it's probably going to bounce. Okay, I'm still looking for a buy. Okay, so Ken says 20-period moving average. That's a good one. I'll start there. And that would be Larry. And then Ken says 32.90. Gil says 33.25. I think you're all in a good area. I would say, to play it safe, I would put a stop. If you're shorting the stock, I would put a buy stop over 33.21, which would be over the 20-period moving average. The moving average acts as support as well as resistance, and there is a very strong role reversal that occurs when stocks cross the moving average. Here's an example. Stock broke down below what was support here at the 20-period moving average. Broke down below support, then the 20-period moving average turned into resistance. We're expecting the same thing to occur here. If the stock closes down below the moving average like it did here again, then that moving average will act as resistance. So again, the buy stop would be above that. I could tell already you're all keeping me pretty busy, so I'm going to try to keep the pace pretty high and go right to Paul. And Paul is looking to, let me see, he bought IPGP. Let's see, IPGP, bought into IPGP at 39? Or is that, did you buy at 139 or just $39? Because I don't see a dollar sign there. Paul, if you could clarify that price, because if it's 139, I would say you have some good news, but you also have some bad news there. So, okay. Oh, you bought this stock at $39 several years ago. Okay, here is my test question for you. Where's your stop? Where's your stop, Paul? I don't mean to put you on the spot, but I certainly want you to protect your profits, because there are gaps well below the market here, and there are gaps down below the market here. So where's your stop? I know, okay, you have a stop at 100. Okay, that's not such a bad, I mean, that's way down there. You got to stop below the role reversal here. But I'm telling you, Paul, I would protect more of that profit and maybe put your stop down here. And if you really want to get short-term with your protection, you could put a stop below your 20-period moving average there. See, and here's why. I already know what I'm going to see when I switch to the weekly chart. Watch this. Boom. There's a vertical price move. You see, when you have fan lines, and I'm going to review this for those who are new to fan lines, what you do with the fan lines, you go back to a long-term chart. Let me erase all these lines again. So you could, let me see, I want to clear all lines. Let's see what's going on there. I'm going to undo clear drawing set. I don't know what that means. Okay, boom. Let me cancel this. It used to have, what, did they change this on me? I want to clear drawing set. I don't know what that means. I'm clearing the drawing set. Boom. Okay. Now, here's a 3-year chart. I'm going to draw a trend line starting with this obvious low. I'm going to connect it to that low. I'm going to project out to this low, and project out. You see how that first trend line is drawn? Now, when you are drawing fan lines, all you're doing is taking the most recent support level on that trend line and projecting out again to the next most accelerated low. So here, the last support bounce, I'm going to this low and projecting out. You see how I'm doing that? Now, I take the last bounce off of there, project it to this low, and go out. That's called the fan. I think you know what a fan looks like. We're handheld paper fans, you know. Take this most recent bounce on that trend line, project out here. Now, we have 4 fan lines right there. Now, as I switch to the daily chart, I could probably draw a couple of more fan lines from here to here. Now, that 5th fan line is something that is fairly unusual because you don't normally see that many accelerations in the trend. So if you're thinking about getting out of this stock, you have to start watching these fan lines, okay, Paul? Because if this fan line breaks, which chances are it's going to, it'll probably drop down to this fan line before bouncing again. You see? And I think that there's a good chance that that gap could fill in the process. So if you want to get a little bit more aggressive in your stop, you could put your stop somewhere below 120 instead of 100 and protect more of that profit. Okay, so you're capturing $20 more of that profit that you have versus having the stop at 100. Now, if you get stopped out, don't worry. One of these other fan lines will give you another chance to get back into the stock. Okay, I have to speed it up. Holy mackerel, you're keeping me busy. All right, now Dell is looking at WTW, and I tell you, WTW, thank you, Dell, says you didn't get time last time, but you've done well with this one. Okay, is it time to get out? Well, here is the daily chart, and I'm not going to give you an individual recommendation on this. I'm going to give you the checklist based on what I teach, and I'm even going to ask for audience participation as I point out the signals. This is basically what's called a rounding bottom. That is bullish while the bottom is forming. When the stock broke out of this resistance high, it gapped up over that high. You see that? And then it accelerated its own trend. So here we have this trend. And if I went back to the weekly chart, which I'm not going to, I could probably find more trend lines. Here's another fan line here. Then we have another fan line here. And then we have the most vertical one right here. Boom. This last fan line, which is the number 4 fan line, is vertical. That's number 1. Number 2, we have a very long shadow above that red candle today. And the shadow shows up on lower volume. Now, with all those things I've just pointed out, excuse me, from the audience, let's do a little consensus. Are the signals that I pointed out more bullish or bearish? What do you think? Accelerated fan lines, drop in volume, red candle with long shadow above the candle, and let's see. The answers are coming in. Larry, bearish. Robert, bear. Stuart, bearish. Ken, bearish. Gil, bearish. All of you are right. The signs are showing more bearish indications than bullish. So I'm telling you, Dell, if you own this stock and you've done well with it, I would say the best thing or the least risk you can take is by selling half the position. If you don't want to get out of it entirely, at least sell half, take half the profit, wait for the stock to bounce off of another key support level, and then get back in on that half that you moved to cash on. Or you could sell all of the position and wait for it to bounce off of another key support level, like we've pointed out in these fan lines back here. Okay, so this is most definitely an accelerated trend, and the positions that have fan lines like this that's so vertical have an extremely high probability of pulling back and correcting. So again, I think it would be safe to say that the stock is probably going to pull back to the $21 area. My forecast is going to be this, and then most likely bounce off of that area. So now it looks like a very, very extreme trend, but when you look at the price points on this stock, it closed at $25.79. A pullback to 21 is not going to be a catastrophic collapse in the stock. It would be just an honest pullback and a correction. So again, if selling half the position and then getting back in around 21 isn't so bad. So that's what I would put out for you there. Okay, now KV, unfortunately, this platform does not give me stocks that trade on the Toronto Exchange. I'm so sorry for that, but if you have another US stock, I would be more than happy to look at that for you. Okay, I'm going to Paul, looking at SLV. Now, I will tell you before I even look at this stock, I have a very heavy concentration in this position. I traded and my wife and I both have retirement accounts. We trade this in our retirement accounts, but I don't day trade it. Now, these are my forecast lines from last week, actually, for SLV. And I left them up here because I look at silver quite often. There was a time last week, back on the 12th, where SLV gapped up and then gapped up another time. My forecast at that point was that the gap would fill and then bounce. And look at that. 2 days after I drew that forecast line, the stock came back down, filled the gap, and then bounced. Now, I told my wife today, I'm telling you, it gets me like you don't even know. When I have a very long position in a stock, of course I want it to go up, but I just hate it when it gaps up. Why do I hate it when it gaps up? Because there's a good chance that the stock is going to come back to fill the gap. Okay? So there's a very high chance that the stock is going to do this before going up. So that's what I think. And again, I have to disclose my position because I obviously have a bias here. But I do think that silver is on its way back up to 17.5. And the reason I say that is because the patterns it's in silver, if you look, you have these very long reversal points or pivot points. You see this? And the angle, once it moves above and below that 20-period moving average, you could see that the angles are very much the same. Look at this. See how the pattern repeats over and over again? Well, this is how I trade silver. I wait for these waves to form. I wait for it to have a wide divergence below that 20-period moving average. Again, those new to that bit of language, we call this the rubber band effect. When the stock has a wide divergence above or below the moving average, if it goes this far below, I tend to buy it. And then when it goes this far above, I tend to sell it. But you can see that the pattern and the angles of these reversals are very, very consistent. And you can see here that even my bounce point was driven in an angle. Even before I drew this line, this is parallel because the angles are pretty much the same. I would say that's about a 50-degree angle on the bounces. I don't have a protractor here to measure that. That was a guess. But you can see that patterns repeat over and over again. So if you're going to buy a stock, you most likely want to wait for it to pull back to support and make sure that the buyers are in force. Who's controlling the stock? The buyers are controlling it. You're more likely to buy it. Wait for the pivot point to form at a support level, hopefully at a support level. Then once you buy it, you put your stop in below support. So if you're deciding to get back in right around $15.85 or $16, you're going to put your stop either below the support or you're going to put your stop below $15.20. I would say the lower level is most likely the best place to put a stop to give the stock more room to breathe. But on the fundamental side, silver is just an amazing stock to trade, the ETF here, because as long as silver is trading below production costs, which is below $19, $20, this to me is like free money. It really is, because silver is one of those things I've been trading for 35 years. And as long as you get a good solid entry point with good strong support, it's almost impossible. Well, I'm not going to say impossible. You could lose money in silver, but the odds are very much in your favor when you stack the candles and react to the bullish signals. Okay. All right. See, David. Oh, shoot. Okay. David's giving me an update on the news out of London. Very, very unfortunate. 19 dead, 20 injured. You know, this is, again, very, very unfortunate. I've already prayed for the victims and their families. I will continue to pray. I have to tell you, folks, this is a different world. It's a different world that we're in. It's like we have to live with these acts of terror, not just in a sense of safety for our physical being, but our money and our savings and our retirements are hinging on what happens in these world events. So the technical signals, you know, give us signs. But the other thing is when markets overreact to news, especially geopolitical news, you could also see when people are overreacting to the news. You see, tomorrow I could easily forecast that tomorrow, because of the news that's coming out right now, tomorrow the markets will most likely open up lower. But I'm not quite convinced that the markets will stay lower. Does that make sense? Because when news like this comes out and the markets are closed, investors are already on edge. It's not like it's happening before while they're asleep. It's happening while they're still awake. Believe me, institutional investors are paying very close attention right now to the ticker tape and what's happening with news. But the market may open up lower tomorrow, but believe it or not, depending on the cause or those who claim responsibility for this, the markets could actually bounce back towards the end of the day. And I know that's a long stretch, making a forecast like this on such horrible news. And we are on a recorded line. And I do that intentionally to show the accuracy of what we do here. But you have to factor this in. And all the more reason why you need to use your checklist, because you don't want your emotions playing into this and putting you in harm's way financially because you're making a knee-jerk reaction to any of the news that comes out. Okay, Jim has been waiting very patiently there for me to take a look at his Under Armour stock, and he bought his first 100 shares today at $17.98. And I will say, Jim, I think you did a good job. I really do. I think you did a good job. Under Armour has taken a beating, obviously, but look at the sideways trading channel. You see this? I'm drawing my support levels right there. Okay, let me go in. And I'm going to draw a parallel channel line right there. Now, when I was in Europe, whether it be in London, I was in Marbella, Spain, I was in Stockholm as well. I was teaching for Tony Robbins in his wealth mastery sessions. There would be thousands of people out in the audience learning how, for the very first time, how to trade technical channels. This is, again, a textbook trading channel. It's like clockwork. You can see the rhythm and how this stock bounces periodically off of that support level. So I'm pointing out these signs for Jim, but also take note for those who are interested in trading channels. This is a support level. What happened on Friday? The stock had a bullish engulfing pattern. Let me zoom in here. Bullish engulfing pattern with a long shadow under the candle. That's bullish, as it bounced off of support in this V pivot point, which again is bullish. It did so with a gap above the market, so the target is higher. That's bullish. So everything is looking bullish for the short term. Your exit price, Jim, your exit price would most likely be at the top of the channel, where you can either sell half or raise your stop up to that level. And the other good thing is that as the stock is coming down, the volume is dropping. So it's telling us the sellers are not really pushing back. You might have a little bit of an argument with today's long shadow, but the idea that you got in, as long as you put a stop somewhere below the support level, I would say a good place to stop is below 17. Do you have a stop anywhere that you'd like to admit a price? Where did you put your stop in? Let me see. Okay, Jim okay, your comment was you learned this from me. Okay, thank you. Now, did you learn about the stop from me as well? Where did you put your stop in? I'm going to put you on the spot on that. All right, 1690. Love it. Yeah, put it below 17, which is going to be below this low from Friday. So that low is 1721. Your stop is at 1690. You're good to go. Hopefully, you're following the 1% rule on that, and you'll be good. Okay, I'm looking at the clock. I have to make this announcement again. For those who have raised their hand as a non-member, I'm going to make a one-time special. Now this, we put this together last minute. Actually, we put it together on Friday, and we're starting to promote this on a very, very short-term offering. If you subscribe to either one of our services, let me go to this one. If you, where is it? Here it is. If you go to our store and you subscribe to any one of the Oracle services here or here, I'm going to give you 2 CDs. The first CD is 20 important lessons for option traders. You can play that in your car as you're going back and forth to the office. The other CD is option strategies to maximize profits. And I will give you an autographed copy of our best-selling book, The 5 Points for Trading Success, if you subscribe as a member to either one of these Oracle subscriptions by midnight tomorrow. So that offer that I just mentioned ends midnight tomorrow. We do this very rarely, and very rarely do I even put a timestamp on it, but we cleaned out our inventory. We're making room for more courses that are coming in. I have a 20-hour course that's coming in where we're going to offer that. I think it's for around $1,900. It's more or less a college course online for technical traders. But this offer that I've just given you is free with your subscription to either one of those oracles, and that could be just for 1 month. I don't care if you get it for 1 month and quit the next month. We don't have any long-term agreements on our products. We don't like to lock people in. We like to give you that freedom to come and go as you please. So that is the offer that I'm putting out. One other thing, for those who are brand new, all of the things that I mentioned, we have free videos on the library. I talked about role reversal. I talked about gaps. I talked about fan patterns. I'd like to highlight the fan patterns right here for those who are brand new. Understand how they work, understand how to trade them, and most importantly, understand how to use fan lines to manage your risk, especially when the markets are starting to form tops. I also talked about the rubber band effect. Right here's a video for you. I talked about the 1% rule for managing risk. I briefly mentioned that. And I mentioned hammer patterns, and I mentioned engulfing patterns. I don't know why those pictures are not showing up, but I mentioned engulfing patterns. So you have a lot of reference material here in our library that you can go to, brush up on, play it over and over again, hit the rewind button, and you'll be good to go. So with that, I'd like to thank each and every one of you for joining tonight. I hope you got a lot of value out of it. I certainly had a lot of fun. Hope you did too. I do this each and every month. I do this the Monday that follows Expiration Friday. So every options expiration, which happens to be the 3rd Friday of every month, the following Monday, I have these open houses. And we don't normally open them up to general public. This one we did. We have about 500 seats available on these web seminars. We come very close to filling those each and every month. But once we get to 500, we're pretty much going to cap it at that, and then go with that group as we go each and every month. So again, folks, keep your stops in place, stay safe, use your checklist, and I'll talk to you soon. So long.
For almost 3 decades, A.J. Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep it super simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is A.J. Monty, Chief Market Strategist for The Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening, and our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our Trade Alert services help answer these 2 questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have 2 services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm A.J. Monty, Chief Market Strategist for The Market Guys. Thanks for watching.
Enrolling in the service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.